Welcome back to Strategic Alternatives, the RBC Capital Markets podcast, where we uncover new ways to raise capital, drive growth, and create value in an ever changing world. In this episode, you'll hear from Francis Donald, Chief Economist at RBC, in conversation with Josh Lipsky, Senior Director of the Atlantic Council's GeoEconomics Center in Washington, D.C., for a timely discussion on the latest on trade and tariffs. Together, they will explore the recent developments in the U.S. and global trade policy and their impact on economic growth. Now, let's dive into the discussion.
Hello, thanks to everyone joining us today. It feels like every day is a historic day lately, and today we are witnessing some very significant market moves in response to more tumultuous trade headlines. I was just taking a look over one period today. Over the course of an hour, we saw stocks move 8% in less than an hour. We've got 14 basis points higher on that US 10-year, a VIX at 50. Clearly, we are still in the middle of historic trade developments and moving headline by headline. And so I thank you for joining us today. And I am joined with an incredible expert to discuss these trade policies, Josh Lipsky, Senior Director of the Atlantic Council's GeoEconomics Center. Josh and I are going to try to give you a little bit of an update as to how economists are thinking through this, and then we're hoping to get some insight from Josh on what's going on in Washington and a framework for us to think about it. And Josh, they didn't put your bio in my intro for you, but it's so impressive. I'm going to take a quick second to walk through it just to give our listeners today a sense of how grateful we are for you. So Josh previously served as an advisor at the IMF, a speechwriter to Christine Lagarde, one of my favorite economists. Prior to joining the IMF, Josh was an appointee at the State Department, serving as special advisor to the Undersecretary of State for Public Diplomacy. Before joining the State Department, Josh, it keeps going. You worked at the White House. You were tasked with helping plan President Obama's participation, the G20, G10, G7, and maybe my favorite line on your bio, not only did you work at Capitol Hill, but at The Daily Show with Jon Stewart. So Josh, thank you for taking time out of what is for sure one of the busiest days we've had in either of our roles. We really appreciate your time here today with us.
Happy to be here.
Now, Josh, I have a lot of questions for you, but I know I'm going to take the opportunity of having a camera here with me to just update our clients as to how we're thinking about the economics of the situation. Of course, extremely fluid. We are going to be publishing new RBC economic forecasts on Thursday this week, and I won't front run them too much, but I thought I might just make 4 quick points about how the economics of this situation is evolving. And what's so complicated for economists right now is that while the developments that are occurring have massive economic consequences and implications, we know that they are not all entirely economically driven. So in some moments, we feel beyond our skis, but luckily we can be grounded in some models that provide us some guardrails and some understanding of how we can think through the economics of what we witnessed last week on Liberation Day. So I thought I might make 4 quick points. The first one for our Canadian audience and for our global audience as well. A week ago, before last Wednesday, most of the trade war conversation was truly focused on Canadian-U.S. relations. And Canada appeared to be the weakest, or the one that was most significantly targeted and most likely to be impacted by Washington trade policy. That, of course, increased the odds of a Canadian recession, created a buy Canadian type of environment in Canada, and encouraged ideas that we would see large fiscal response from Canada, as well as Bank of Canada cuts. What was so interesting from the Canadian perspective last Wednesday is we went from most targeted in Canada to least targeted in Canada. By many measures, Canada is now going to see some of the lowest average import tariffs out of all the major economies that were targeted. Now, one might say Canadians can breathe a sigh of relief. I know that I did when I was trying to scroll through the small type when it came to who was going to be tariffed and by what amount. Except that now Canada is facing new and different challenges. Whereas before we were spending our time thinking, what is the GDP impact of steel and aluminum tariffs and auto tariffs? We still have to do some of that. But our focus is now thinking to what I might call the old school considerations for Canadian growth. That is, oil prices are dropping. Big challenge for Canada in general, especially for our clients and the businesses that are out west. And the very quickly, rapidly rising odds of a US recession. Many of us spent a lot of time learning that when the US sneezes, Canada catches a cold. And while we might have been focused on a Canadian specific recession, the odds of a US and global recession are rising very rapidly, in fact, by every hour. And in that case, Canada is now susceptible to the global storm that is brewing. Some ways that's more complicated for Canada because it's not a Canadian specific negotiation in play. And it makes us a little bit more vulnerable to what happens in China and Japan and Europe and how the United States responds to it. So a shifting of concerns in Canada, not an elimination of them. Now, number two is how do we adjust forecasts? I mentioned this morning we had at one point a rumor that tariffs would be delayed 90 minutes that was then reversed just a few minutes after that. The White House called this a form of fake news. So economists are trying to come up with what is an appropriate base case to use as the most reasonable path forward. There's lots of ways that you can do this, but we have to start with the United States as sort of the epicenter of the global situation. We've run a variety of scenarios. We're going to publish the one that we stick to on Thursday. And I'll give you a spoiler alert. The one we pick will probably be what is still the case on Wednesday this week. We're just going to try to see what sticks and whether tariffs come through on Wednesday. But what I can say right now is that if we see tariffs 10% plus up to 20%, which is currently what is being proposed, the odds of a recession as soon as Q2 or Q3 for the United States climb very, very quickly. Now, much of that will depend on how long those tariffs stay in place. So we have to make assumptions, and Josh, I'll be coming to you with that question for sure. If tariffs are in place for a month, it's a very different outcome than if they're in place for a year. We have to get a sense of retaliation. And unlike when we were just trying to get a sense of whether Canada was going to retaliate, we now have to make assumptions about how all 186 countries are going to retaliate moving forward. When we run these models, our biggest concern, however, is not growth. Growth is one concern. It's American inflation, which was already acting too sticky. Most of these scenarios gives you high threes on inflation, and that's certainly far too hot for central bankers and for Americans who have already suffered through one of the largest, if not their largest price increase in their entire lives. A reminder, when we went into COVID, most folks had not experienced a 20% increase in their cost of living before. They have just gone through this, and the appetite for inflation is probably more limited, and the ability of the system to absorb it also more limited. The United States unemployment outlook is really interesting this time, and that's because if you've heard us talk before, you know we're believers that America doesn't need jobs, America needs workers. 40% of Americans do not work. U.S. has the most amount of retirees ever. In fact, 3 retirees right now in the U.S. for every 1 new unemployed entrant. And so we don't actually have a massive rise in the unemployment rate, even in a scenario where we see a U.S. recession. That'll be challenging for the Federal Reserve as they try to get a sense of how they offset the inflation to the unemployment outlook. Now, as I said, the biggest risk to Canada now is a U.S. recession. And if we do see a U.S. recession come through, we will unfortunately have to also say, to a smaller degree, a Canadian recession as well. So the number 3 point I wanted to say is, while we're trying to remain grounded in models, we know that our models have certain limitations, in large part because we don't have much of a playbook for this massive and historic shock. One of the largest trade shocks, or the largest trade shock we've seen in over 100 years. And so even economists can admit that, well, our growth models, they're probably not going to capture as much downside risk as they should. One of the reasons for that is we know uncertainty is weighing very heavily on Americans and Canadians, and now on Europeans and Asians as well. African countries, all of these folks are having to make assessments over the duration of tariffs and what their own country's retaliation is going to look like. We in Canada know that uncertainty has created a stall out in investment and hiring, even without tariffs actively in play. This is now a global phenomenon, and I'm going to tell you, economic models have a hard time capturing it. On the inflation side, we also wonder if, even though we see much higher inflation, high threes in the United States moving forward, if that's really capturing the upside there as well. And that's because, well, we know from surveys that some companies are going to raise prices even if they aren't impacted by tariffs, taking advantage of some of the increase in prices. And we also know from past experience that if tariffs are put on and then removed, a lot of companies don't then go and reduce their prices after the fact. So we're looking for all of these stories that perhaps aren't implicated into an exact economic model, but imply that even in most forecasts with low growth and high inflation, the risks are even lower growth and even higher inflation. The last point I wanted to make is on monetary and fiscal policy. And if you followed our work before and our 7 ways to measure how a tariff flows through your economy, you'll know that there are 2 major backstops that can support or mollify the impact of tariffs. One of them is how central banks will respond. In Canada, we continue to believe that the Bank of Canada will cut interest rates down to 2.25%, although they've continued to say they can't be the full backstop for what's happening. Some areas of the economy would require much larger rate cuts than that. Other ones would require much higher rates than where we are now. They have to come out with something in the middle. But Canada and Europe and even China overnight have something the United States doesn't, which is they are capable of expanding fiscal policy right now and have the desire to do so. So there is a backstop coming from provincial policies. We heard one policy from Ontario overnight that is happening across the world, but is absent in the United States. And that brings me finally to the Federal Reserve, the market pricing in 4 to 5 rate cuts from the Fed. But their job is not straightforward as they try to tackle very high inflation, the most that this Fed has seen outside of COVID, and an unemployment rate that will rise but remain low by historical standards. We'll see how that shakes out. We'll be watching very closely to see which side of the mandate the Fed falls on. But the US, as I mentioned, is not expanding government policy. They're actually trying to reduce the size of their deficit. So that is a very big difference between the US story right now and the Canadian one. So I hope that gives you an overview of what economists are thinking about today, understanding that the situation is fluid. Now, Josh, I want to hear from you. You heard all the uncertainties on my side. You got to help me out here. And the reason we've come to you in part is because right after the election outcome, you and the Atlantic Council, you were very clear there was going to be a global trade war, that this was not going to be a question. Tell us how you came up with that. What was the framework, and how are you using that framework to think about all the events that are happening now on an hour-by-hour basis?
Yeah, and thanks for having me today, and look forward to the conversation, and greetings from a very busy Washington on this Monday afternoon now. So we came in after the election and week after said there's going to be a trade war, and it's going to be much different than the first time around. And the reason we said that is because we looked at everything the president said in the campaign. We talked to his advisors, many of whom are senior fellows of ours at the Atlantic Council. And we understood fundamentally that tariffs are one of President Trump's core policy convictions. And it goes back to the 1980s and his relationship in New York with Japan, with the real estate market in New York. So he has long held this view, and it was in check in the first term, largely by a range of advisors who would not be present in the second term. And so we broke out the way President Trump thinks about tariffs in 3 main categories. The first is tariff as negotiation, and we're all familiar with that. He used it that way in the first term. He certainly will use it that way in the second term. The second is tariff as tariff, and I think this is sometimes misunderstood in the conversation about President Trump. This means tariff as a true macroeconomic tool, either to raise revenue, which I think is the primary objective of the reciprocal tariffs, or to restore domestic manufacturing. Now, there's a tension there, because if you're raising the revenue, you're not reshoring and restoring domestic manufacturing. But all of those fall under the bucket of pure macroeconomic use of a tariff, And it's critical for them to raise revenue because they have to offset the cost of the tax cut extensions that are coming this summer. And so when they talk about the projections, whether those are realistic or not, and we think they're vastly overestimated, they are using that as a public relations tool to skeptical Republicans in Congress to say you should pass our legislative agenda come this summer. And so everyone who thinks this is going to be negotiated away has to understand they need some of that core revenue to make their case. This is why we believe tariffs will stay in place. The third bucket is tariff as punishment. And this is new in the second term. This is tariff as a form of sanction. In the first term, President Trump used financial sanctions, as many presidents have. But it was clear in the campaign they believe financial sanctions lead to de-dollarization. We have a dollar dominance monitor at the Atlantic Council. We look at these issues, but that's clearly their belief. And therefore, they're leaning into the tool of tariff because they like the ability to ratchet it up and ratchet it down. Financial sanctions are binary. You turn them on, you turn them off. But tariffs can be scaled, as President Trump has showed his interest in 5, 10, 15, 25, and back down the ladder. Unfortunately, we haven't gone very far back down the ladder, only up the ladder. So when he tweets something like BRICS countries are going to be tariffed at 150%, that's not tariff as negotiation, and it's not tariff as macroeconomic tool. And so you have to approach everything he's doing with that mindset. That's how we looked at it. And the reciprocal tariffs, which we can talk about, are really, I believe, tariff is tariff. We're living much more in the second bucket here. I think that's what the markets are realizing and why we've seen the prices we've seen over the past week, and less is tariff as negotiation. That's broadly the framework we use to assess President Trump's tariffs.
I think that's really useful. And much of what you're talking about are things that we have seen before, like sanctions. We've seen some tariffs from President Trump before, but a lot of this is still feeling very new. Could you talk a little bit about the historical significance of so-called Liberation Day? And then I was hoping within that context, you could describe a little bit how this may be altering relationships with both allies and adversaries.
Yeah. Well, it's interesting you use the term allies and adversaries because I think President Trump doesn't see the world in terms of allies and adversaries, probably unlike almost any president since World War II in the United States. We have said for a long time that he sees the world in terms of bilateral trade deficits and bilateral trade surpluses. And if you need proof of that, just look at the Rose Garden ceremony last week and the formula used and the way that chart came out there. That was a ranking of every country in the world, Canada and Mexico exempted, as we can talk about, on bilateral trade surpluses and bilateral trade deficits. He sees this as taking advantage of the United States or not taking advantage of the United States. He sees it transactionally and has much less store and stock in the traditional ways we think about historical alliances and partnerships. Now, that's not a perfect model. You know, Iran is still an adversary in his mind, even though Iran got a 10% tariff and Israel got a 17% tariff. So it doesn't work exactly, but it's useful to understand it's a very different approach to bilateral relationships than almost any president before him. And we are in a historical moment, and I think it's very important, and we talk to the Trump administration officials often, they believe the trading system is fundamentally broken. So when people come complaining to USTR and Commerce and say, why are you doing this? Their response is, we've been warning you for decades this was coming, and we are done negotiating. Now, that can also be a good negotiating posture. Let's be clear about that. But I do think it reflects some of their worldview that if they have to break it, they believe it's already broken. And this is where the language about pain and we just have to bear it and go through it comes from. It's not just posture from them. They think the system is fundamentally unfair, and they understand it will be very difficult to reform. I think the question is, what do they want on the other side? To break it is one thing, and it's clear they have an ambition to do that. But what they want to rebuild in its wake, I think, is much less clear. But we are in a moment right now where the United States, which built this trading system over 80 years with partners and allies, including Canada, now no longer wants to be a part of it and does want to uproot it. And the question is, how much financial and economic pain can the administration endure to follow through what I believe is a core conviction for them?
This isn't the first time that we've seen tariffs, as we mentioned. Is there anything we can take from past trade wars throughout history, or even the 2018, 2019 tariffs that have come through that are helpful guides for this situation? Or is this really sort of a blank playbook and tariffs are an entirely different game this time around than they were in Trump 1?
I'd say it's more in the entirely different game spectrum than there's a model which we can work off of. A lot of people have been talking about Smoot-Hawley in the 1930s in the United States. Of course, at that point, imports only represented about 5% of US GDP. They're closer to 15% now. So the scale of what we're talking about on a trade war could actually dwarf what we saw in the famous protectionism of the 1930s. And 2018, 2019 is going to look like a drop in the bucket compared to what this is. We're talking about washing machines back then. There was steel. There were a couple sectors targeted across China. But now, 70% effective tariff rate on a range of Chinese goods, 40% across Asia. So this in scale and scope is unlike anything we've ever seen in the modern global economy. And the real question over the next 48 hours is how much will he follow through with? And we can talk about that. But at least what's being advertised right now, and I think what is intended to be followed through on, there's no good model for us to fully understand the impacts.
Josh, I think a lot of us are trying to understand what it's like in Washington, D.C. right now. I mean, my colleagues and I over the weekend were trading Ted Cruz podcasts and trying to look at Besson's speeches and really trying to get inside the mind of a Washington that is grappling with a really sizable stock market drop off and economists globally that are saying the U.S. is heading towards a recession. Can you give us some insight into what people are talking about in Washington right now and the conversations that you're having?
Yeah.
I feel like you're a better takeaway for me than trying to listen to the podcast while I walk my dog.
No, we're listening to the podcast too, so I think that's not a bad way to go. What everyone's talking about is what does Trump want? So a lot of embassies, and we talk to countries around the world here at the Atlantic Council, they are not opposed to negotiating. They are coming quietly over the weekend to Treasury. But that's different than having the ear of the president. So there's a bit of a disconnect now from my perspective of what the White House wants, what President Trump wants, what Peter Navarro wants, versus maybe what Treasury is and USTR is at. But that's all fluid and in motion. And I think what countries are saying and what we're hearing in Washington is, how does he actually want to negotiate? What they thought was they were going to get a series of tariff and non-tariff barriers that were listed. This is what was advertised ahead of the reciprocal tariffs. Instead, they got a calculation based on bilateral trade deficit. Well, countries can't just fix their bilateral trade deficit. They can't fix it in a week or month or even a year. So the big debate right now that everyone's talking about is how do we negotiate? But I think it misses that he doesn't want to negotiate. That doesn't mean there won't be deals to be had, but fundamentally, he wants to follow through on a range of these because the revenue is the driver of what they see as the quote unquote good stuff. That's how they describe it to us. We got the bad stuff, but the good stuff is coming in the summer. And they're looking at a cycle over 2 years going into the midterms of how they weather the economic storm now, but rebuild over the next 12 months and have a positive economic story to tell. I think that's a very risky gamble. We've been calling it an inside straight here at the Atlantic Council to slow the economy, to grow the economy. But that's the conversation here in Washington.
Is an inside straight a sports reference? Because it flew over my head, so I'm going to assume that's what that one is.
It's a poker reference, actually. So
you know what? Same category for me. Okay, so you're helping me out a little bit here because you're mentioning some timelines, and as I said in my opening comment, what economists are really grappling with is how long do these tariffs stay in place? How long do we have to be enduring this? And what are the thresholds for lower growth? So you mentioned the summertime. Is the administration willing to withstand sort of a Q2, Q3 recession as long as they can see growth back by the midterms?
Yeah.
Is there a stock market red line in the sand? Is it the 10-year yield in the sand? I think everybody wants there to be a magic lever that you can pull. Maybe it's a combination of all of them. Walk us through a little bit, what would it take to call the whole thing off? And what kind of timeline should we be thinking in terms of how long these tariffs have to stay in place for this government to achieve its stated goals, revenue, reordering of trade, et cetera?
Yeah, this is the question everyone's asking right now. What is the pressure point? What is the point where they say, this is enough, we can't take this anymore? I don't think anyone has a great answer other than to say, I think it's higher than the markets are pricing it. I think that their tolerance for pain in the equity markets are higher, and we've only seen that in the past week. We'll see where we go this week. And you mentioned the 10-year yields. That's clearly a priority for them. They have correctly diagnosed in the United States the frozen property market, the 30-year mortgage market, and they are focused on getting that down. The problem for them, and look at the 10 years today, it's not reacting on the way you might think. This is what I meant by that inside straight reference. The complicated mix of things they're trying to do, if there is a grand strategy here, to slow the economy in order to rebuild it, can backfire. And the question is, how many pieces does that take before they relent? And we don't know, other than I think they are very focused and believe that if they can get to the summer and pass the tax cut extension before Congress goes on recess in August, it'll be a win for them. And that's why we look at this in a 2, 3, 4 spring and summer month timeline to see how this evolves.
In economics, we often talk about the Federal Reserve trying to orchestrate a soft landing, which is kind of to thread the needle. And it sounds like what we're looking at is a Washington trying to attempt a soft landing as well. Those long-term yields, I'm guessing Washington is reading RBC Economics US research, which has really been saying that this is the biggest problem for the United States, from the housing market to how corporates are leveraged. But one of the second biggest problems is this inflation side of the picture. Do you have any insight on how Washington is thinking about inflation in particular, and a government that really ran on the idea of bringing prices down, and one that's probably going to have to jawbone a lot around higher prices for Americans starting as soon as right now or tomorrow?
Well, this, I think, is arguably one of the most complicating and dangerous factors going into the next 12 or 18 months. So we're in April now. Next May, Chair Powell's term is up. And so the question is, over the next year, will we get an early nomination? It's pretty clear Chair Powell's not going to be renominated, but an early nomination of a new Fed chair, and create what's being called in Washington a shadow Fed chair situation right now. And all of this is connected to your question, because the issue here that's being debated right now is the Fed going to come to the rescue of President Trump? And we've seen no signs of that so far, because they believe correctly this is a man-made problem. It's a man-made recession based on policy choices. This is so different than the global financial crisis or the COVID pandemic, where the Fed and the G20 would rush to the rescue, swap lines, everything they could to stabilize the global economy. They think it can be fixed by policy choices. They're correct about that. And they want to show no sign that there's going to be a Fed put coming. Now, is there a point where they would feel like they have to step in because of the pain to the US economy? Probably, but this is what I mean by it's much higher than most people think. All of it's because of the unique dynamics of the crisis that's created by policy decisions, not by exogenous shock factors.
I want to switch gears a little bit to a headline that made a lot of news in Canada just over the weekend. So a Democratic resolution passed the Senate that would nullify presidential emergency on fentanyl being used to implement tariffs on Canada. Was this largely symbolic? What kind of power does the rest of Washington have if they disagree with tariffs? Are there any, is this the tip of the iceberg? We may see this type of thing implemented more broadly, or is this very Canada specific? And does it have any implications for Canadians right now?
So what I would say, it's a good question, is that Congress is not going to come to the rescue here. There's not going to be a piece of legislation that passes the Senate and the House, even if it gets through the Senate, which is a big question mark, but certainly nothing that would get through the House that would rein back in the president's tariff authority. What could be a mitigating factor are the courts. So the president is using the International Economic Emergency Powers Act for many of these tariffs. That is a novel use of the legislation. Legislation dates back to 1977. It was passed in the wake of President Nixon. It was meant to curb in executive power, not unleash executive power. And what he's done is basically say this piece of legislation, which we usually use in the US for sanctions, is now being used to introduce tariffs. It appeals to him because he can introduce them immediately. There's no notice and comment period and a review like a Section 232. So what he's doing now is using it in an uncharted way. And the first court case just popped up this week in Florida from a paper company saying, here, we are concerned about this and we are going to sue you on the usage of doing this. We would have had lawsuits earlier, but many companies and corporates are actually scared of retaliation right now, to be quite frank about it. And that's why we haven't seen lawsuits. So the question is, this will eventually go up to the Supreme Court. Will they rein in the president's use of IEPA, the International Economic Emergency Powers Act? That will take months to play out. But I think that's the only way from a legislative and legal situation where you see one of these key tools that's being used in the second administration that was not used in the first changing, and that would reduce some of his ability. But that's where we're looking, the courts, not Congress.
Makes sense. So we mentioned earlier, a lot of us are trying to grasp at the psychology within Washington and listening to a lot of talking heads and those that appear close to the president. Who particularly should we be listening to when it comes to who is having the most influence right now on these types of policies? We've got Bessent, we've got Navarro, we've got Letnick. Do we have sort of, a whole buffet of these and we take them all at equal weight? Do you have any guidance on who we should really be tuning into?
The first thing I would say, and I know this might not be a satisfactory answer, is listen to President Trump. And the reason I say that is there are many times where Secretary Bessent has said things over the past 4 or 5 weeks that President Trump has said essentially no to, even hours later. We think about the scaling up of tariffs. There's something Secretary Bessent said in his confirmation hearing. We will phase them in 2.5, 2.5. President Trump said no. So this is what I meant at the beginning. It's one of his areas of core policy conviction. And so it's important actually to listen to him. Then if you're talking about the advisors, it's Peter Navarro as the first among equals. He is the one that is running the trade show inside the White House. The reciprocal announcement, the bilateral trade deficit calculation, this reflects his thinking more than any other. So if you have to rank who to listen to, first the president, second Peter Navarro. If you don't hear it from them, I wouldn't bet on it.
Very helpful, and a nice reminder after this morning when we got whipsawed around by some headlines in either direction.
Yes.
So I have one more question for you, and it's perhaps a little bit selfish, which is that when we're looking at predicting out or forecasting U.S. growth, we don't just look at the next year. We're often developing sometimes 1, 2, even 5-year forecasts. And one of the really core elements of a long-term forecast for a country is population growth and what's going to happen. So I mentioned we're really preoccupied with the idea that America is short workers right now. They have a huge demographic bust in play. And I wondered if you could opine on some of the other policies outside of trade that we should be keeping an eye on at the same time. Immigration is one area that I'm really interested in, so I was hoping you could start there. Yeah. And what else is kind of happening in the backfield? I'm going to try a sports reference. Outfield.
No, and, I got that.
That we should be keeping our eye on while we're also mesmerized by the trade developments.
Well, thank you for asking a non-trade question, because it's been at least a week since I talked about an issue outside of trade, so I appreciate that. First, you're right about immigration. It remains the president's most popular political issue. If you look at the polling, his numbers are going down quickly on the economy, no surprise given what's happened in the markets, but the immigration numbers are holding steady. So if they're looking for some kind of pivot or some kind of way to regain support that they're losing over the economic shock factors right now, it's pretty safe bet they're going to return to the immigration agenda, which has been the other core policy conviction of President Trump. If you were to say, what are the two core policy convictions? It's trade and tariffs, and it's immigration. So I think we'll see more on that coming. The other thing I would emphasize is digital currency. This is an interesting administration from the cryptocurrency front. They are, by their own accounts, unleashing crypto. And I was just in Hong Kong 2 weeks ago talking about these issues. And the view from other parts of the world is that this unleashing of crypto could have enormous financial stability implications all over the world, including through dollar-backed stablecoins. 98% of stablecoins are pegged to the dollar. The administration's view is this should spread. It's a form of dollar dominance from their perspective. And I think there's a backlash to this growing. So this tension between crypto, stablecoins, what the administration wants, all overlayered with a much more volatile and weakening global economic picture, I think could add fuel to the fire of what's being created in the macro sense. So I point to immigration and crypto as 2 issues to track.
So Josh, I was semi-hoping that we'd come on today and you would tell us there's high possibility that tomorrow we wake up and this issue is gone. But what I've heard from you is actually this reordering of global trade is a high conviction view from Washington. And while the details might be adjusted, it certainly has legs and is something that we should continue to consider as part of this economic outlook. I'm wondering if you could leave us with some advice. So many of those on the call today are operating businesses in Canada and the United States. Many are invested. Could you give us a way to read through this? What advice do you have for us as we read through the noise, we see the market volatility, and we continue to try to make decisions in a world that appears to be changing very, very rapidly?
Yes, I will do my best, and happy to continue this conversation as we all navigate this together. The biggest mistake I think the markets made was over-indexing on Trump 1. And what I encourage everyone to do is remove Trump 1 from your memories. This is a completely different administration. It's different in his approach to government. It's different in the people around him. It's different in the policy objectives. It's different in the electoral sense because he's not running for re-election. So the biggest advice I can give to those trying to navigate policy is forget about what happened 2016 to 2020. We're misremembering it or over-remembering it or trying to put what's happening there into that box, and we're making mistakes in terms of projection. Look at it from what he said in the campaign, look at who's around him, and take what he's saying seriously because they mean it and they believe they have a very narrow window, maybe 12 months, to execute a major policy overhaul of the United States, not only on trade, but on a range of issues. And you've seen it in how they've approached government. Here, the DOGE process, you've seen it on immigration, now you're seeing it on trade. So my advice is, and this is the old adage about Trump, we have to take him seriously. And therefore, the question of everyone else in the world is, so what will we do about it from our individual country perspectives? But don't plan for things going back to normal. This is a new world that Trump is building, and whatever comes after it, I think will look very different, both here in the US and around the world. So the best advice I can give is approach the policies for what they are and as advertised, and I think that will actually give a much better guidepost to what's to come.
Josh, those are powerful words to leave us with on a day that feels powerful in and of itself. So I want to thank you so much for taking your time with us today. And we look forward to reading more and hearing more from you as the situation evolves and the economic landscape evolves. As I mentioned, RBC Economics is going to be updating its outlook this Thursday. You can find us at RBC Economics and follow us on LinkedIn for more information. And if you have any questions over this period, we want to be there to assist you. It's tumultuous. It's a more difficult operating environment, but RBC and your RBC representative is there to support you through that period. And we really urge you to lean on that person. Once again, Josh, thank you for joining us. Good luck today and tomorrow and in all the weeks that follow. We appreciate it.
Same to you. Thank you.
You've been listening to Strategic Alternatives, the RBC Capital Markets podcast. This episode was recorded on April 7th, 2025. Listen and subscribe to Strategic Alternatives on Apple, Spotify, or wherever you get your podcasts. If you enjoyed this episode, please leave us a review and share the podcast with others. See you all next time.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.